Hey, this is Danielle, and today I'm going to be showing you how I'm going to close my unbalanced fly. This is a trade that I did for Salesforce earnings. It was an overnight trade. Right now, you can see that I'm making about $280 on this. And I'm going to go over the trade and I'm going to show you how to close it. Now, first of all, I want to say that this was actually not my trade idea. It was my friend Henry's trade idea. Yesterday, I was in the trading room and I was looking at Salesforce. I definitely wanted to be long going into the earnings report. If you look at the earnings hot zone, you'll see that Salesforce has gapped up, you know, 3 out of the last 4 quarters. They also had recently been increasing their EPS numbers pretty substantially. I also liked the fact that Salesforce had a pretty good implied volatility increase. And so I was looking for a vol crush. Now, when you look at where Salesforce was trading yesterday, the biggest issue with it for me was just the fact that it had already had this big run. When I'm bullish on a stock, and I think they're going to do well over earnings, but yet I think the stock probably won't explode just because it's already had a huge move. Last quarter gapped up 8.1% as breakaway gap, very bullish setup, by the way. That leads me to think, okay, how can I trade this in a way in which I can take advantage of theta decay and vol crush? But the stock doesn't really need to explode. But if it does, that's great. Now, I was in the trading room and I was the last hour before the close, and then Henry came on for the close. What I was looking at doing was I was going to sell some put credit spreads at the $300 strike. The reason for that is because it's a key psychological value. It's where you have a lot of liquidity, a lot of high open interest. And I was going to do that for a 1-to-1 risk reward. I put the trade on pretty small because I lost money last week. And whenever that happens, I generally like to start off with a little smaller position size, to just get back in the swing of things. And so that's why I did the smaller trade on Salesforce. Now, I was looking at the put credit spread and the potential of doing a bullish fly at 320. And then Henry came on and he said, you know what? Actually, I'm going to do the unbalanced fly at 300 instead of the put credit spread because the risk to reward ratio was about 1 to 3. So it's risking about 1 to make about 3, much better risk reward ratio. So I ended up taking his trade instead of the idea that I had. So what does that look like? Well, what we did was, let's go down to the options chain here. Salesforce was trading, could go back and see exactly where it was trading, but it was right around $300 a share yesterday. And so what we did was we set up this unbalanced butterfly. Now, when you get into an unbalanced butterfly, you're going to see that these strikes are not even. You have one long put at 305. You have 3 short puts at 300, and then you have 2 long puts at 295. Now, I'll point out a couple things. Number one, with the spread, you are protected, in case there's a PA and W situation where it gaps down 20%. This is a defined risk trade. When I put on this trade, I was risking a max of $250. Like I said, it's a little bit smaller than what I normally like to risk, but just kind of in a grumpy mood after last week got me a little bit. So that's what I did. Now, when I'm risking $250 and I'm making 283, that's really good. It's a little bit better than 1-to-1. That's how you grow a small account. Okay. So with this fly, it was a defined risk spread. I never could have lost more than $250. But the way that this is positioned was it was positioned so that the implied volatility would be crushed at a critical support zone in a place that had a lot of volume and open interest at a specific strike. Okay. So just think about it this way. I was bullish Salesforce. I thought it was going to go up. I didn't necessarily think it was going to explode, but I wanted a strategy in the options market where I could take advantage of implied volatility, crush, and theta decay. And the unbalanced butterfly is a way to do that. The reason why this is a way to do that is because you are long one put at 305. Okay. and then you are short 3 at the 300 strike. At that 300 strike, yesterday, those puts were going for $12.20. Now, what ended up happening was because Salesforce went up, it's up above $300. Um, and what that means is that the implied volatility was crushed out of these options. And we also have theta decay because there's only one more day left. Now, in the options market, the reason why you should trade earnings, the reason why I trade earnings is because there's this phenomenon where the implied volatility goes up going into earnings. That means the price of the option goes up into earnings. And then afterwards, it's going to go down because that major event is over. There's no reason for those options to be juicy. So, if you can use a strategy in which you can optimize your implied volatility crush and theta decay by placing a defined risk spread where you are trying to crush those 3 short options at the 300 strike in the instance where this stays above 300, you have yourself an overnight profit and an overnight trade. Now, you may ask, well, Danielle, didn't you say that he was risking 1 to make 3? How do you make 3? So I could try to do that. But generally with these earnings trades, I like to get in and get out just overnight. In this case, it's actually 12:20 Central Time. So, or sorry, I'm in Pacific time now, 12:20 Pacific time. So I did hold this until the end of the day just because I actually held it just so I can make the video for you. Um, but the way that I would make more money on this trade is if the butterfly actually pinned. Now, I wasn't trying to make the butterfly pin. Pinning the butterfly, what that means is that the stock goes directly to, oops, sorry, that's supposed to be a circle, directly to the center strike at expiration. So, for example, CRM is trading at 307 right now. If the stock fell down below this long put and it stayed in this range, especially if it went to $300 and it hung out right here, that's how you would get the max profit on the butterfly. So I wish I had a screenshot of the risk reward when I got into it yesterday, but I forgot to take one, so I don't have it. But I believe it was around $700 max profit if the ticker is trading right around 300 at expiration. I'm not going to do that because, like I said, I just do in and out earnings trades. Anything can happen tomorrow, and I just want to take my profit off and I want to put some new trades on. So I wanted to make this video because I know that unbalanced flies are really complicated. When you get into the trade, you are actually buying to open, but you're getting in for a credit. So when you look at this, it's like, well, I don't understand. Negative 227. That's because I got in for a credit. It's just like a put credit spread, except for you have one more. Put there. And so what you're doing is you're getting in for a credit. And in this case, I'm actually going to get out for a debit. So while I bought to open, I'm going to sell to close. I'm going to try to get out right here. Let's see. Oh, I guess I don't have to copy the order. Let me just take a screenshot. It's always helpful to take screenshots, especially for me when I'm trying to make videos and I'm trying to remember exactly what it is that I did. So it's actually going to say credit right there too, which is also why it's confusing. But here we go. Send. All right. So with a butterfly, any kind of butterfly, okay, and now I'm out. So there we go. So with a butterfly, any kind of spread, it's really important to get out of the trade like as a whole. You definitely don't want to be trying to leg out of a butterfly, which means, you're selling this strike and then you're selling that strike because it will mess up the risk to reward that you initially had when you got into the trade. I don't like to do that. I think it's really risky, especially if you don't know what you're doing. And so people ask me all the time, how do you get out of butterflies? Well, I probably should have gone a little slower in the video, but you basically just right click on sell your butterfly, and then it will take it as a whole trade and keep it together. I guess I could show you another example. So Microsoft, I have a couple different positions on here. I have some long calls, and I also have a butterfly. Some people will come to me and they'll say, "Well, how do you make sure you're, getting out of the right trade?" Because what can happen is that people will not have their arranged positions on properly. In this case, if you go to this little menu right here, arrange positions, I have mine selected by order. If it's not proper, do you see how I just took that off? Now I have call, 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 and it's like, oh my gosh, what is that? That's a huge mess. So in that case, yeah, you would have to get out of one leg at a time, but that's a nightmare. Please don't do that. So instead, if you arrange your positions by order, then you can see, okay, these are my long calls and this is my butterfly. So I'm not getting out of Microsoft right now, but if I was going to, all I would do is right click, create closing order, and you can leg out of it, but I'm not going to do that because I don't want to break up my risk. Just sell the butterfly, which again, I'm holding it because this looks great. So thank you very much for joining me today. This was today's edition of Trade Review, and thank you, Henry, for the trade idea. I will see you guys soon.